staples is doing just fine. I mean, actually, not just fine, is doing very solidly well, and that is showing up in prices as well. So this is a flat start, I would say, neither here nor there. Almost a holding pattern until I guess we get data points which are lined up ahead over the next 24 hours or so. Rahul Singh is our market master of the day. He's Chief Investment Officer, Equities at Tata Mutual Fund. Rahul, great to have you with us here. Thank you very much for being with us on CNBC-TV18. First thoughts on markets near term, Rahul. We are down, but far outperforming, emerging markets, Asian markets, and of course, I mean, the G10 big global developed markets as well. Will the outperformance last, even if the market weren't to do very much on the downside, or you think there is downside from here? What's your sense?
Yeah, hi. I think let's take a step back and actually nothing much has changed in the last 3 months. The global macros still continue to be uncertain. The interest rate trajectory continues to be upwards. At the same time, if you look at our domestic economy, I think there are enough signs that there is credit growth coming back. The cyclicals are doing well. So essentially, it remains a tug of war between the domestic cyclical recovery in various data points which we continue to see, and the uncertain global macros. And I don't see this changing over the next 3 to 6 months either. So which way the needle will swing more is difficult to say, and I think the critical point remains crude prices, because that is something which affects India's macros and India's macro parameters much more than maybe the other emerging markets. And I think that remains a key thing to watch in deciding or in determining which way the needle will swing. But as things stand today, I think there is enough and plenty of data points suggesting that the domestic economic recovery and cyclical recovery on the capex side, on the real estate side, is pretty solid, and I think that's the heartening part. But that obviously cannot completely negate if the global macros continue to deteriorate, and so we need to keep a close watch on both sides, frankly.
Okay. By the way, forgot to mention that Varroc Engineering, the stock is under pressure now. Actually, it's down almost about 4% after that deal. The value of the deal has come down quite a bit. So Varroc Engineering now 3% lower. Keep an eye out on that. Talking about autos, Rahul, thanks for joining us on CNBC TV18. Wanted to ask you a little bit about your view on how to approach the auto sector. Anyone and everyone is bullish on it, and there is a multi-year bull run that people are now talking about. Is that a very simplistic argument given the kind of disruption that we could see in this space, and how does one approach it?
Yes, it is simplistic because autos is not just one homogeneous piece. I mean, it is comprising CVs, tractors, two-wheelers, four-wheelers, auto ancillaries. So every segment to itself, and the fundamentals are panning out to be quite different. In some cases, there is a top-line lift, or there is a cyclical lift, like in CVs, whereas in others, it's more about coming off a bottom in terms of the lack of growth which has been there last 3 to 4 years. And in some cases, it is just just wishful thinking in terms of the fact that the sector has not done well, and the stock should do well now. But there is really no substance in some of those stories or some of those theses. So really, we need to take a more bottom-up approach, frankly, in autos. It's not very easy to take a very homogeneous approach, like it is easy to do it in, say, in the case of banks or in the case of IT services. You can take a more uniform approach across the sector, and you may not go wrong even if you pick a mid cap versus a large cap, or a X segment versus a Y segment. Whereas in autos, it can be completely different. So that's why we don't tend to treat autos as one homogeneous segment.
Hi Rahul, morning. I wanted to focus a little bit more on the consumption theme. We've had a couple of numbers that's coming in there, and discretionary spending, it hasn't really got pulled back, at least till now. And the view is that maybe given that the festivities are there in this third quarter, things could look up. What's your view? How would you approach this theme? Because you have Godrej Consumer that came out a little bit disappointing out there. Dabur was a little bit disappointing. However, Titan, Kalyan Jewellers, great updates. How do you approach the space?
Yes, I think there is a dichotomy between the urban and the rural consumption. If I were to simplify what you're saying, although things are hardly that simple, we are seeing that the urban discretionary consumption is pretty strong and pretty solid, and it's not only showing up in consumer but in other areas like travel, leisure, airlines, etc., in various segments. Whereas on the rural side, there is obviously a moderation or a slowdown, which has been persisting for quite some time if you look at the commentary of the FMCG companies. So clearly there are two large kind of segments which are showing very different trends. We think that that will start narrowing. This difference will start narrowing sometime in the second half with the rural coming back. But the valuations in the space overall means that we will have to back growth on and companies or sectors where we see growth surprises are possible. So instead of simplifying these themes, I think our focus and investors' focus should be on identifying companies, even if it's in urban consumption or rural consumption pocket, companies which are executing well and which are able to surprise on the positive in terms of the growth trajectory which they are demonstrating. And that is how I think the consumption space should be approached, because if you look at the interest rates going up and if the overall thesis that with interest rates going up globally and in India over the next 3 years, you will see some moderation in valuation and some excesses in valuation. We need to be extremely choosy in the consumer sector, but India is a large market, and there are companies which are able to grow fast with either great execution, market share gain, or just gain from the unorganized sector. So there are opportunities. It is not, I'm not trying to suggest that there are no opportunities, but there are a lot of opportunities available still where companies are executing quite well in various spaces across the consumption spectrum, actually.
Rahul, is there any broader kind of macro-ish risk here with what's happening with the rupee? It's kind of fallen to about 82.20. Oil, according to many who watch the space, is headed higher again. Reasons are lining up. Is there export? We got the export numbers, which has been underwhelming, right? I mean, even excluding oil, which is a big source, which is the biggest import, our exports have not been doing all that great. So there is a bit of a gap, and that the risk is that could increase the deficit. Are those kind of things going to come to kind of plague the market at some point? And what's the risk? What's the probability of that, in your opinion?
No, as I mentioned, the probability of things going into a tailspin on the rupee or on the external account or the BOP is basically going to be a function of commodity prices, and more specifically crude prices, because we are a net consumer of crude and various other commodities. So we need to obviously keep a watch on that, and I think geopolitics also will start to play a critical role. Is already playing a critical role, but I think it's going to become more and more important for us to take a call on that, and therefore it becomes a difficult call to take. It is no longer about demand and supply of commodities or crude oil. It is more about what's going to happen geopolitically, how's the OPEC going to react to it, and so on. So will they try and protect the prices? So that is the single biggest factor which could go against India. And as I was mentioning earlier in response to, I think, the first question, that can decide the swing of the needle, which way the needle swings more. Because right now, it's a tug of war which is fairly equal between good domestic micros and not so great global macros or deteriorating global macros. Right now, it's a tug of war which is not moving either way too much.
Just a quick word from your end, Rahul, on the IT sector, because now the opinions are changing. People are saying perhaps it's a good time to be buying IT stocks after the fall that we've seen. Would you concur with that view, or are you still cautious?
I think some relief has come by way of the USD INR movement. Although I think USD INR movement is never a good reason to buy the sector. In the past, if you see periods when INR has depreciated, it's not that the sector has performed. So I think it's a little bit early to get too excited by just the currency movement. on the sector. I think the large caps are placed well because after every recession or after every slowdown globally, the outsourcing increases, and these large cap companies or the large cap IT companies who get to share much more in terms of the large orders which get given out after any major recession when the global MNCs start to go on a new cost cut drive. So I think the sector will come out looking well. But in the next 3 to 6 months, given the uncertainty on the budgets, and now that we are entering the period when some of these budgets will be decided, will I think might throw up some negative surprises. Not major, but I think some negative surprises we should be prepared for. So we are, I would say, underweight on this sector relatively compared to what was the case, say, a year back. At the same time, it is a sector where we need to keep look at the large cap IT names much more closely and take these dips or take these periods of uncertainty in terms of demand environment as an opportunity to accumulate and maybe keep the weightages at these levels definitely.
All right, Rahul, thanks so much for stopping by and giving us your quick